Three, two, one. Welcome, friends, to 0 Days to Expiration. That's right, 0 days to expiration. This is episode number 100. Can you imagine that? 100 episodes. Well, this is going to be a doozy. What I wanted to do was talk about how you actually profit using a zero DTE strategy in a bear market. Now, in order to do this, I have to give you a little bit of context. So I'm going to tell you how we did last year in a bull market, how we did this year in a bear market, and what is it that makes this strategy different from all others. And today was a really good illustration of why this strategy is different and why this strategy makes money while other strategies would have lost their shirt in this market. Today was a crazy day. It was what some people might call a distribution day, maybe a trending day, and then a complete reversal. And so I don't know what it turned into, a variation abnormal distribution day or something like that. That's in the market profile parlance. So, this being the 100th show, let's talk a little bit about where we were and where we've come. Today, we have somewhere around 750, maybe 800 members in our trade room. They are active. We have hundreds and hundreds of messages every day. They are all supporting one another, all coming up with their own variation of this strategy. Now, we started this service, about a year and 6 months ago, about a year and a half. In the first 9 months of the service, I wanted to show how you could take a small account using zero DTE and grow it. And I did. In about 9 months, we took a very small account and tripled it. But that was in a very different market. That was in a bull market, one that was just fed induced, just fed. When I say fed, I don't mean like eat. I mean the Federal Reserve just pumped money into that market or pumped that market up, and it just went bonkers. And so it seemed almost surreal how well this strategy actually worked. But we weren't under any delusion that that was something that was going to continue under all market conditions. So then the market turned around, obviously, in the beginning of this year. And we felt it in January because we tried some of the strategies that we had come up with, variations of them that were getting a little bit too aggressive, and we got bit by that. And so that kind of gave us a pause and said, okay, now we're in a bear market. This is a different story. Let's go back to our roots and continue with that strategy. And we did. And we've done spectacularly well in a bear market as well. So that is proof positive, first of all, that this version, or our unique way of trading zero DTE works in both bull markets and bear markets, as well as sideways markets and bear market rallies. Now, bear market rallies, I would say that those are the toughest markets to trade. So how is it that this strategy, this zero DTE or 0 days to expiration strategy, is different from all the others? It is almost exactly the opposite of what everybody else does. Everybody else is following the, quote, tried and true method of high probability strategies that virtually every retail trader is familiar with. Typically, the way the other guys trade zero DTE is with an iron condor, which is generally thought of as a market neutral strategy. Now, let me ask you this. When have you ever known the market to be neutral? Once in a while, but that is the primary strategy that they'll use in this market. So they'll then put on a very wide iron condor to try to make up for the fact that it's not really a market neutral way to attack the strategy. You need it so wide that it ends up with a very tiny profit potential and huge risk on either side. Now, if you make it wide enough, then you'll feel like, it's so far out there that I don't have to worry about it. I feel good that I'm putting on a 90% probability of profit trade. Now, keep that in mind. A 90% probability of profit trade. So they put this trade on. It has maybe $900 of risk and maybe a potential of $100 of profit, but they don't take that full profit. And the reason why, there are a couple of reasons. The way this strategy works, you're hoping that the premium decay will rise up and come to a certain point where then you can get out of the trade. Now, you're thinking, well, it's a 90% probability. Why not just let it go? Well, what happens is that often, as the market does, like today, for instance, the market was just all over the place. The market moves. When you move in an iron condor strategy, you start moving towards the risk portion of that strategy. And that risk is huge. So imagine this, you're in there, you have $900 of risk, you're hoping to make $100, which is really not what they're really hoping for. And then all of a sudden the market moves and you're sitting there $200, $300, $400, $500 down. You're still inside the profit tent, but it's hard to take now. You're now 5, 6 times underwater for what you were hoping to collect. Do you have the temerity? Do you have the courage? Do you have the cojones to stay in that trade and hope that it doesn't go another few points to the left and gives you a max loss? The answer is no. So what they do is they shortcut this and forget all about defined risk and all that, because their defined risk is just so outrageous that that's not the risk that they want. So they put on stops, and those stops are typically equal to about 3 times the credit that they could potentially receive. Okay, we're going to take this 95% probability of profit trade. We're going to cut it down so that it's now like a 60, 65% probability of profit trade with a $300 hard loss. So when you hit that limit, you're a loser. There's just no two ways about it. You have lost. You're out of the trade. There's no defined risk. It's defined loss is what it is. So that's the way they trade. Now, let's say that price stays right in the middle. You're hoping that premium will decay and price will move up and your strategy will be worth more. They set an arbitrary limit of about 50% of the profit that they would collect. Now, consider this. It's $900 risk, $100 of potential profit. So their risk to reward is about 9 times risk, 1 time profit, right? So it's pretty bad. And that amount of profit there is so small, it takes a long time during the day for that premium decay to build enough so that it will fill up at least 50% before you can get out. And the reason why they chose 50% is because they don't want to chance staying in that strategy too long for fear that the market will move and put them back into that same situation where they hit their stops. So not only are you taking a high probability strategy, shortcutting it, turning it into a low probability strategy with tiny little profit and the chance that you're going to get kicked out with a big loss, that is the nature of the current zero DTE strategies that are out there. That is the, I guess, quote, state of the art. And now, yes, you can limit things by being very proactive in terms of your risk management, but that's what you spend your time all the time is managing your risk. The mistake that they're making is to assume that the probability of profit, the expected move, is something that they could actually rely on. And it just isn't. And that is because the underlying models that determine pricing in options, things like the Black-Scholes and others, they're assuming a static volatility and static liquidity, which couldn't be further from the truth. It's never static. It's always moving. So therefore, your odds are always changing. However, they're trading it as if the odds never change. So that style of trading is fundamentally flawed in that way. I joined a service a few years back because I was interested in the zero DTE, and I'd been doing zero DTE trading for many years since weekly options came out. I think it was back in 2005. So I wanted to see what they had, and it really intrigued me that with the S&P, you could trade options 3 days a week. So it was truly a nice day trading opportunity with a nice cadence where you took Tuesdays and Thursdays off. And then recently, it went up to 5 days a week this past May. So it seemed pretty cool. And when I entered these rooms and discovered their strategy, I couldn't believe that they were risking as much as they were. So I would introduce a different way, a way that I'm used to trading. That is the way most professionals trade. And that is where you flip the risk to reward equation around and take tiny risks for huge outsized profits. And the way we did this, or the way I did it, was essentially take a butterfly and put it out of the money, recognizing that the probability of profit and these options models were really not something I could rely on. The only thing I could really rely on is the risk that I was willing to take and for the potential profit I want to go after. So I did that, and then I showed them in the room how I could take 1/10 the amount of money, put it at risk, and make 2, 3, 4 times what they were making on their iron condors. And a lot of people were really enamored with this. The owner of the room wasn't so much enamored, and he kicked me out. So I decided to start this service. That's exactly how this service started. And you can go back and I think back to April of last year, when I started the podcast and talked about all of that, and you'll see the progression of what we did. Fantastic year last year. And it was really based on a completely different idea, more in line with the math that has been developed by notables like Benoit Mandelbrot or Nassim Taleb. Their philosophy is really what is the underpinnings of everything that we do here in terms of the way we handle or manage risk. In fact, we don't really manage risk because we are under the correct assumption that you cannot manage risk. You cannot use these models to be able to predict with any kind of accuracy what's going to happen in the future. So for that reason, you can't take big chances. All you can do is put yourself into a position where if it does work out for you, you can profit big. And so that's exactly what we do. That in effect is the major difference. And I call this the inversion of risk principle. And it is, like I said, built on top of the philosophy, the underpinnings of mathematicians like Mandelbrot or Taleb talk about. It works in any kind of market. You can take very, very small risks for huge outsized profits. Now, the big difference is in the distribution of returns. Now, in the distribution of returns, that's where, a lot of people aren't really looking at that. I'm sure that people that are logging their trades aren't looking at their distribution and recognizing that it's not really a normal distribution. It's something very different. A high probability strategy gives you what's called a negative skew. That means that you make a lot of tiny little positive profits, right? And then some losses, and then occasionally some really big losses. So that negative skew gives you a long-term negative expectancy or less than desirable expectancy. The way we do it, by choosing our risk to reward scenario, we create a positive skew. So we only have tiny little losses. We can never have a big loss. Lots of tiny little wins that offset the losses, and then a plethora of medium-sized wins and then outsized wins that really propel your account. And so what that actually does to your account in terms of the equity curve is, first of all, you have very, very, very small drawdowns. This past year, the last 100 or so trades, my drawdown has never exceeded 3%. Now that's pretty good. And the kind of volatility I have on my equity curve is absolutely minimal. And my long-term expectancy is miles ahead of the other strategies. Now, there's another benefit to it. Because the equity curve and the drawdown is so minimal, and we have that nice smooth equity curve, we're never really feeling the pressure of losses. And the reason for that is that we trade very small. There's no need to trade large, not like they do. They're normally putting up $1,000 to make $100, but they're not making 100. They're going after 50. So they're really putting up a 20-to-1 type of risk to reward. In our strategy, we're never doing less than a 1-to-6. We're usually looking at 1-to-6 up to 1-to-12. So when you look at the efficiency of what we're doing, we're anywhere from 20 to 40 times more efficient, capital efficient, than those other strategies are. Now that makes a huge difference in the trader and how they, or the problems or the things that they encounter or are confronted with. So we are no longer interested in, like they are, in managing risk because our risk is truly defined and it's small. So we're not spending all our time managing that. As a matter of fact, virtually all of my losing trades go to 100% loss. It's no big deal. They're small. And so what I'm left with then is to manage the profits. So completely different paradigm. They are managing risk. I like to say they're managing losses. We are managing winners. And that's the primary difference between the way Zero Dash DTE does their strategy, our strategy, and everybody else does theirs. Fundamentally different from everybody else. Now, there is another really big difference, and that is in the way we do our analysis. Now, we recognize that using probability and expected move and all those things, we know that implied volatility is regularly overstated. We know that the expected move is hardly ever the expected move that you get in your platform, that 5 delta or a 20 delta hardly ever reach those maxims. They either go over it or under it. It's never there. So how do you rely on it? And the answer is you can't. So we don't. Right? So that's the big key right there. We do not rely on that. We rely on what we're willing to risk and what we think we can manage as a profit. And that's it. So there you go. There's the primary difference between what they do and what we do. Now, this comes into huge application and huge benefit in markets like this market, this bear market. Since the beginning of 2022, this bear market has really been something. I mean, it's incredible. It's historic. And it worried us at the beginning when we initially took some of these very risky trades. We thought that, okay, we've got this all handled. We'll put on a broken wing fly. It has risk that's 3.5 standard deviations away. We'll never have to worry about that. And we put that on twice in 1 week and lost 2 times out of 4 trades. Did the probabilities tell us that that was going to happen? No, it wasn't even close. That was a 99.8% probability of profit. Right? Imagine that. 99.8%. And still we lost twice in a row. What are the odds there? What good are those platform odds to us then? And so that's when we came to the realization that after coming out of that bull market, that those types of strategies are just not worth it. So now we never take that kind of risk. All of our risk is always well defined on both the near side and the far side, because we don't know which way the market's going to go, regardless of whether or not we have an unexpected 100-point move in the market and then a reversal of another 100 points. It's not going to help. It's not going to hurt us. It's not going to help us. But we're never going to feel that risk ever. And in fact, we can actually profit from that a great deal. As a matter of fact, that was kind of like what happened today. That was exactly what happened today. We're in a special situation now that the market is coming down and hitting these levels that are really, really scary, because we know that there's a lack of liquidity down below. And as I said, these probability models that they use, built on, say, Black-Scholes and others, they are assuming that volatility is static and that liquidity is also static. And we know that both of those things are not true. So we cannot rely on those probabilities. The only thing we can rely on is what we're willing to risk and what we're trying to grab as profit. Now, when you look at what our expected return is, or what we expect, what is our long-term expectancy, that all comes down to that distribution. Remember, I talked about the positive distribution. We get exactly what you want. We have the kurtosis and the fat tail profits that Nassim Taleb talks about in spades. We never have large losses. They're all contained, very small. We have about 50 to 60% of our wins are small also, that offset those losses. About 30% are medium-sized wins anywhere. Now, here's the thing that's going to really blow your mind. Those other guys, while they're going for, they say 50% of the available premium. But in fact, what they're really going after is the percentage of premium that they have versus the risk, that's their real risk. They're really going after 10%, and they're going after half of that 10%. So they're really going after 5%. So while they're going after 5% of their risk, we are going after, on average, anywhere from 150 to 1,500% of our risk. Now do you see the difference? There is no comparison. We're in a completely different league. There's no way to compare these. We are, as I said, 20 to 40 times more capital efficient. We use less. Now, here's something. I decided to take a look at all the different competing zero DTE services. Like all of us, like good stewards, we put out our logs and our results. And so I took all of those results and I compared them, right? I compared how much money that they put at risk to make how much, whatever their return was. So I'll give you an example of one, and this is typical. So this other service, they, over the course of a couple of years, they used as much as $250,000 cumulative dollars in risk to make about $3,000. All right, $250,000 of what they put up in total margin, or actually almost 300, to make about $2,000 or $3,000. For that, this is the crazy part. Now, what I did in 3 months, which is very typical of what we had going way back, I put up about $2,500 of risk to make $4,000. All right. Take all that in. $250,000 to make $3,000, or would you rather put up $2,500 to make $4,000? That's the difference. That's the difference. It says it all right there. Now, today was an amazing day. It looked like one of those days that I would characterize the start of a bear market rally. And bear market rallies are absolutely the most difficult type of condition to trade in, and that's because the market is so fickle. You get these intraday reversals that are just amazing. Like today, we went up 73 points and then down 73 points, all in one day. And that was on an expected move of only 32 or 33 points in the morning. That's crazy. So how can you rely on that expected move? You can't. I know for a fact that those people that put on those iron condors, they probably got kicked out of that first one. I mean, they had to, just based on their strategy. If they put on another one, they probably got kicked out of that. And put on another one, they probably got kicked out of that. And then it was reversed. They got kicked out of every single one of them. Every single one of them just totally blew away their probability metrics. With us, we put on one trade. It went way up out of range. There was really nothing for us to do. We have our defined risk. We didn't do anything. It came all the way back, and now we profit. And not only did we profit, but we profit more on that one trade. Even if it didn't go to max trade, even if it went to one of the minimal size profits, we profit more in that one trade than all of the trades that they would have, if they had profited on all of those trades that they put on. But instead, they probably had, I would say, if they were trading their strategy, 3 to 4 losses, and we had 1 win. And if we had a loss, it would have been super tiny, about 1/10 the size of only one of their trades. Again, big difference, huge difference. So hopefully you're seeing this and you'll join me in watching future episodes of 0 Days to Expiration. Again, this is episode number 100. I plan on doing this at least 3 times a week, maybe 5 times a week. It's always live. You can come on and you can add your comments, and looks like there's a lot of members here that are commenting right now. So I'm going to give a shout out to everybody. Let's see. We have Brent. How you doing, Brent? And is here. He says, hello, what's seemingly an out of the blue dump in the market? Would love to say I'm surprised. We're not surprised because we kind of expect it. Jim S is here. How you doing? Noob, that's a new person. That was a bear attack Deum. All right, whatever that means. Reza is a new member. He just closed his very first 10 times 0 DTE trade. Thank you. He bought a 35.75, and it looks like it was about 30 wide. Wow, for $1.50, and it boxed in at $15. So he made 10 times his profit. All right, that's one of our new members. So he just made enough profit to pay for 2 years, 2 full years of this service. Yes, it was a great job. Thank you, Jim. Makes you want to come back for more. Absolutely. So we have Tim Dodds. How you doing? Reza, that was an excellent trade. Thank you very much. Matt M, giving his shout outs. GK. All right. Via Noob wants to know, what do you do for profit targets? We don't have any such thing as profit targets. That's really a misnomer to think that you're so adept that you can tell what your profit's going to be. We don't know. We take what we can get and we try to manage what we have achieved. So if we can only achieve a 100 or 150% return, that's what we take. If it ends up that we can get 200, 300, 400% return, that's what we take. Every once in a while, we get that pin trade and we'll make 600, 700, or 1,000% like Reza did today. We'll take that. Those aren't targets. Those are management of your profits. If we had targets like they had, we would be shortcutting ourselves all day long. And there's no reason for us to shortcut ourselves because we're not going after a tiny little profit. We're not worried about all the gamma risk that they're worried about. We're in a better position, a high quality position, where we're managing our profits, not our risk. That's the difference. So if Adam says, great trade, I like how you bought it for yeah. A 1 to 19 risk to reward. That was awesome. All right. Let's see. They're all just Googling over Reza. That's fantastic. Really happy for you. At the Money Options says, do you have education for the strategy or do you just send out alerts? Well, first of all, it's not an alert service. It is not an alert service. This is a coaching and mentoring service where I'm teaching our members how to become professional traders. So while I do have alerts, they're really my trades, and people can follow my trades if they want. But generally, people are in this service to learn how to become totally independent traders. So they'll often take their own trades based on the strategies and the methodologies that we teach here. Now, by the way, all of our technical analysis, there is none. We only use volume profile and our unique version of volume profile that nobody else uses. We talked about it yesterday in yesterday's podcast. So you might want to go check that out. And it is a game changer in that regard in terms of having a better understanding of where are the hot zones or the liquidity and non-liquidity zones in the market. So yes, we do have education. There's a course and there's also resources that are inside. We do daily live streams with the group. We do a weekly retrospective, which is kind of a recap of the week. And of course, I am in the room all the time. Every member gets my personal number. Every member that joins gets a one-on-one coaching consultation then and as well anytime they want, quite frankly. So it is something well beyond just any alert service. This is truly a group coaching and mentoring service. And again, my goal is to make every single person in that service successful. All right. Yes, let's all be like Reza. Yes. Well, today was a crazy day, so it wouldn't have been unusual if you missed it. I don't know how you would have missed it because it came right down into the profit zone after a long run up. Let's just take a look at this sucker. Look at that. Whoop. And then it went sideways and then just fell off a cliff. ZW is a new member. Is there a track record of live trades from the beginning? If you go back to all of the previous shows over the last year, you can track it. I do show what my end of year results were. And then I decided to just over the last several months is to do a very complete, detailed track record of what I'm doing because everyone was asking. Like I said, that's my track record. So I never really felt like it was appropriate to put it out there as representative of the group because everybody is an individual. Everyone progresses at their own pace. It's not an alert service. So we're not professing that this is a systematic strategy and it's prescriptive and you can put this into place and then you'll make this much. That's crazy. That's as crazy as trying to say that the probability of profit has meaning, which it doesn't. So, but I decided to put my track record up there. It's up there. You can go to the website under trade logs and you can see the detailed report of my performance. Oh, good to hear, Diesel. And Vio Noob says, great point on managing the profit. I am also intrigued by the zero DTE stuff. Let me just say, it's great to be intrigued by it because I think zero DTE presents an incredible opportunity. But you also have to recognize the way we do it has nothing, absolutely nothing to do with what the other people do, other than the fact that we're trading the final day of expiration. That's about it. Everything else that we do is 100% focused on, like I said, the underpinnings or the philosophical models that have been developed by people like Benoit Mandelbrot or Nassim Taleb. Skin in the game, asymmetry, convexity, antifragile. That is all built into how we actually conduct our trading. As I said, it's a more of a realization of what the truth is in these models for options pricing. They're based on false assumptions. They're based on the idea that there's a static amount of volatility or a static amount of liquidity. And we know both of those things are absolutely not true. Particularly in today's market, you can see that for yourself, but it's not that way at any time. So you can't play those odds as if they have meaning because they have no meaning. They're based on false assumptions. All pros know this. Most retail traders do not. All right, that's about it. I want to thank you very much for joining me on the 100th episode of 0 Days to Expiration. I can't wait to do the next 100. Again, thank you all. Take care. Peace to you all. Oh, wait a minute. I got to get the big head back here and give a proper goodbye. Peace to everybody. Thank you very much for showing up. If you'd like to join the service, go down below. You can either click the join button here on YouTube or go down to the description where you can try out our service for 4 weeks. That's it. Thank you. Take care.